So, basically, what is an interest rate?
In banking and finance, an interest rate is a percentage connected to borrowing or saving money. An interest rate helps determine how much extra money may get added over time. Interest is the real extra dollar amount people actually end up paying on top of the original borrowed money. The interest rate is the percentage used to calculate that extra money. Interest rates are often connected to things like credit cards, loans, mortgages, and savings accounts. In general, a higher interest rate means borrowing money becomes more expensive. A lower interest rate usually means borrowing money becomes less expensive. These are general rules because borrowing costs may also be affected by loan terms, APR, promotional periods, fees, or other costs. To see how interest rates can affect borrowing costs, let's look at a very simple example. Borrowing $10,000 with a 5% interest rate may cost much less over time than borrowing the same $10,000 with a 15% interest rate. A lower interest rate may help people pay back less extra money over time, while a higher interest rate may cause borrowing costs to grow much faster. In everyday life, many people accidentally confuse interest rates and APR because both of them are percentages connected to borrowing money, and they can sound very similar at first. APR is similar to an interest rate, but it often includes additional borrowing costs as well. Very simply explained, the interest rate helps calculate the basic interest, while APR tries to show how expensive the loan really becomes overall per year. APR may also include certain fees or additional borrowing costs connected to the loan. That's why APR is often slightly higher than the basic interest rate. That's why many people carefully compare both interest rates and APR before borrowing money. For example, someone borrows $10,000. The interest rate is 7%. The APR is 9%. This does not mean that 7% plus 9% equals 16%. That is very important. Instead, the 7% is the basic interest rate, while the 9% APR may already include extra fees, loan costs, yearly costs, loan origination fees, and other borrowing-related calculations, such as setup fees, application fees, or account costs. Now let's look very simply at what may happen after 3 months. If we calculate based on the 7% yearly interest rate, 7% of $10,000 would be about $700 over a full year. 3 months is about 1/4 of a year. So very simply explained, about $175 interest may have been added after 3 months. That is the interest, meaning the actual extra money. However, the APR may be 9% because the bank may also have included some of the additional costs mentioned earlier, such as loan costs, yearly costs, loan origination fees, setup fees, application fees, account costs, or other borrowing-related costs. That's why after 3 months, there may not only be about $175 in extra interest costs, but perhaps about $250 to $300 in total borrowing costs. So, the normal interest rate calculates the basic interest, while APR tries to show the more complete borrowing cost. That's why APR often shows the more realistic yearly borrowing cost. And that's why APR is very important in real life. Even a small change in the interest rate, or APR, can make a surprisingly large difference over time. That is especially true for long-term loans such as mortgages. So basically, interest is the real extra dollar amount people actually end up paying on top of the original borrowed money. An interest rate is the percentage used to calculate that extra money. APR is a broader yearly borrowing percentage that often includes the interest rate plus additional borrowing costs and fees.